and welcome. We're delighted to have you here. We know you're a superstar in terms of Thinkorswim. Nobody knows more about Thinkorswim than Don, and we had requests for Don, so we're delighted to have him with us. Go right ahead, Don.
All right. No, you know what? I'm not going to prepare anything too formal for today. I'm going to open it up to a lot of questions because I just watched the last, 10, 15 minutes of what you guys were talking about. So it does appear that we have some Thinkorswim Analyze kind of geeks in here. So you guys tell me where you want me to spend a little bit of time on here. So obviously I'm really familiar with a lot of the option analytics on Thinkorswim, but my group, I left in 2015 now. It's been a lot of years. So it's been, I exited about 5 years ago, but my group actually also, we built charts and the scanning feature inside of Thinkorswim. So yeah, I can pretty much walk you guys through almost any area of the platform. And, I was actually kind of laughing there when somebody was talking about day stepping. There were some great arguments back in the day about day stepping, volatility stepping. By the way, the last trade that you guys did, which is, I've seen, obviously I've been I was on the brokerage side for 15 years. I've seen so many different derivatives of that particular trade. I think it started called the road trip trade. I've known Jim Riggio also for probably 20 years. I can't tell you how many times I've actually seen it, and I can tell you exactly what you need to use if you are going to place that trade. And it's not day stepping. You're going to want to do volatility stepping. So just bear with me here for 1 second. I'm going to show you guys something interesting on that particular trade. Is that okay if I go on that theme right now?
Sure.
All right. So if we cruise over to the SPX, it doesn't matter what we pull up in the SPX. I know you guys had an iron condor. I can't believe anybody's still trading this thing after the fees. Okay. How could you do it? The SIBO is now charging fees for the SPX. And frankly, I stopped trading it after that. I would literally rather do, 100 lots in the spiders and find a brokerage firm with all you can trade than step into the SPX. I'm furious about some of the fees they now actually pass on to the clientele. Anyway, all right. So here's a put spread, and we'll throw in with it any given call spread, right? So it doesn't matter what the strikes happen to be. I take the trade, I right click, come over to why sell a wider put spread than call spread? Okay. And I'm not being facetious with that because the skew is against you in the call spread. You'd actually collect a hell of a lot more if you actually sold the wider call spread and a more shallow put spread. That way you're actually trading, okay, with the implied volatility skew, not against it. Does that make sense to everybody? Meaning that it's like one of the most simple things that I never understood because I've seen so many different variations of this trade. Why wouldn't you want to sell like a 20% implied volatility and be buying like, an 18% implied volatility? Instead, you're out there, you're selling like a 25 vol and actually buying, for instance, like a 26 vol. You're actually putting the skew against you on the trade, which if you were to do that, hundreds of times, starts to actually weigh in on the trade. Nevertheless, with this trade, so the one thing that'll get you on trades like this is going to be a bump in volatility. So when you look at these trades, first of all, you're exactly right. You should initially come in there and day step them. This at expiration, okay, this is actually put in there. Wait, I've got a drawing tool I can actually bring to light. See if I can make this a little bit easier to see. Here we go. All right. So this is a trade or this expiration +1 right here. You know what that hard line is for? That's actually for what we kind of we used to joke internally and say it's the happy graph that a lot of retail clients like to see. The reality is, okay, you're never actually going to hit probably anywhere near there because most of your strategy are going to be exited prior to. So the most effective means is to actually come in here and day step it. And what day stepping is, and again, some of you probably understand quite a degree about day stepping. Others of you are probably maybe a little bit newer to it. You guys comfortable? Anybody ever done this before? I'm trying to watch the chat at the exact same time here. Maybe, sometimes, never. Okay, I can't see the chat right now. We okay? By all means, let me know. Sorry if I lost you guys here for a second. All right, sorry about this. I'm just popping back into, it moved on me here.
No, it's fine. People.
No, it's all right. No, I apologize. The Q&A
fine.
actually moved to the point where I can't read it. It's off one of the other monitors. It's okay. So as I was saying, if you've never used the day stepping, what day stepping does is it actually shows you effectively now, okay? And we have 7 days stepped. So if you take a look at the legend, it's just 7 days stepped. So it's the profit and loss graph proceeding here through time. Obviously, it's +7, +7. You can put in any time frame you want over here. So this is one of the first things I would highly suggest for any of these types of trades is, of course, to day step them. The second thing, for those of you that are going to do this trade, I would actually look at what's called volatility stepping. And this is actually a tool that I built along with a guy by the name of TP, Tom Preston. And what vol stepping happens to be, okay, and you really need this right now. Like if you've never looked at volatility stepping, especially in products like the SPX, what volatility stepping does is it says right now, the implied volatility is 26%. What happens if vol actually jumps by, okay, we're stepping by 5%, which is actually 5 VIX points. So if the VIX right now is trading roughly at 26, it'll say, what if the VIX is 26? What if the VIX is at, 31 and so forth and so on? And it's actually showing you P&L, okay, in those terms, because what you have tendency to get yourself into very frequently with any type of iron condor trade is you're a victim ultimately of volatility exposure. And that's what every single iron condor, no matter how you want to slice it, every single iron condor, you're going to be a victim of volatility exposure. So if vol bumps, you're actually going to take a hit, okay? But obviously, as long as you end up inside your break-even points, you assume that you're going to be okay. But that's actually a little bit of a fallacy. That's inside your break-even points, of course, by what? By expiration. So again, kind of toggling back and forth, you're going to see some great variations. And the reason I just mentioned like volatility stepping, anytime I see a strategy like that, what occurs in strategies like that, and I'll just give you the rundown. After 15 years of watching this, okay, on the other side of it, when I say of watching it, at Thinkorswim, we watched people, we watched different strategies, and you make money month number 1, you make money month number 2, you make money month number 3. By month number 4, you actually you're the next Warren Buffett. You're no longer doing one lots inside of the SPX. Then you're capped in 10 lot. And by month number 5 or 6, you're hitting it out of the park with 10 lots. On month 7, you get completely and totally wiped out and you're over your boots. What you need to actually see in this particular strategy is adverse volatility conditions. And it's the silent killer in here. It's actually the silent killer of portfolio margin accounts as well. So the moment the vol picks up, it changes everything. And I wanted you to see your risk graphs in here and float your risk graph with what's called volatility stepping. So yeah, I know the first time you throw this into, you realize you're not in Kansas anymore. Vol stepping gets pretty serious. One of the things you also want to do with volatility stepping is, and people will look at like the Greeks and so forth. Okay, see this Vega over here? Pay less attention to it because the Vega calculation over here actually incorporates a lot of the calls. Calls don't really cause you volatility risk, although they appear in terms of Vega as causing you volatility risk. So it's again, these numbers can be a little bit misleading because you really technically don't have volatility risk if you go up. If you're short a ton of calls over here, right? If you're short calls and we go up, volatility typically where? Goes down. So your vol is falling. How do you have Vega risk if we're actually going up? The risk to the upside is always what we term intrinsic risk, which is the short calls going in the money is the only thing that really starts to damage you to the upside. So once again, when I saw the strategy a moment ago, and I came in here and I was watching for just a few minutes. I asked, okay, why do the smaller call spread? Obviously, I don't have this call spread. Why do the smaller call spread? Because there's no volatility risk to the upside. To the put side, though, there is volatility risk. So inherently, I would rather sell the larger call spread, sell the smaller put spread, let the skew be with me, and actually mitigate a lot of my volatility exposure. And I promise you, on behalf of every brokerage firm in this country, they hope you do the same thing. All right. Risk mitigation of volatility exposure, especially when you're actually stacking contracts on something like the SPX, is all they really care about. It'll also help you in terms of portfolio margin to sell the call spread rather than the put spread. Actually, you're very likely to hold more margin as we slip to the downside. Volatility expands and holds more margin on the put side if you are a portfolio margin trader. So that's it. That's what I got to begin with. Was that all right? Okay. Everybody okay? All right. Let's continue onward and upward. Don, I was going to let you just ask some generalized kind of questions in here. So by all means, feel free.
Well, I guess we could. I don't know. Let's see. Mark posted, so maybe trade positive Vega.
Yeah, so positive Vega, if you wanted positive Vega, use out of the money like put calendar spreads. Okay, if you wanted to offset some of your volatility risk in there, you could just buy out of the money put calendar spreads. It's not a half bad way to mitigate some degrees of risk in there.
Let's see, Robin Hubel says it is not a call spread. What about an in-out spread on the top side? I'm not sure if he's referring to.
I think he's referring to is actually buying a call spread. I've actually been, I don't mind saying this, I've actually been a premium buyer for quite some time. I grew up as a premium seller. I'm actually net long right now. I'm not necessarily net long like Vol, but I'm definitely I'm net long back month units. I'm looking for constant volatility expansion right now because you look at everything that's just happened in the last couple of weeks here. This is an interesting way to look at the marketplace. What you're looking at over here, this is a script that a buddy of mine wrote on my request. It's got everything from standard deviation over here, but what you're actually looking at is like IV percentile, but it's a true percentile. It's not like a ranking. And what we actually did is built almost like an RSI into this. So this is the RSI 20, RSI 80. And what it effectively says right now is, and again, you're on a 1 year chart in the SPX. Okay. What it effectively says right now is you're at the lower edge, if you will, of the implied volatility percentile based on, some of the action that we've obviously seen on a year-to-date basis. And that's including March, everything until this point. But implied volatility is incredibly low right now for some of the trade action that we're seeing. There's one other interesting aspect of this, and I look at this. I look at implied volatility versus actual price movement. I don't necessarily chart implied vol versus historical vol because I think that's a little bit cheesy. But the way that I actually map this is on a week-to-week basis. These are the expected moves every single week. So when you look over to an options chain, over to the right-hand side, this is probably the most underused feature in Thinkorswim that should be widely utilized. These expected moves are deadly accurate right now. All right, in especially for the Friday expirations, those expected moves each Friday afternoon. I will draw the expected move for the following Friday afternoon. Let me actually clean this chart up a little bit and show you. And if I come in here onto a 1 minute basis, this line that's drawn across your screen right there, you know what that happens to be? It's the upper edge of the expected move inside of the SPX. And we're literally just pinging off of it. The reason I'm bringing this into scope is, again, I know a lot of you guys are selling premium. By looking at week-to-week expected moves, like just looking at expected move. So let's say expected move is equivalent to $78 for a week. That means $78 higher, $78 lower. Okay, that's the expected move for a given week. That is another way of looking at implied volatility, right? So if you're looking at this, the implied volatility is denoting we're supposed to move $78. That's the standard deviation for 1 week. The question is, and everybody always asks this, did we really move $78? This week, we're already home. Last week, we broke through it. We also had, coming off 1, 2, 3, 4, 5, 6 weeks. There's a great way to handicap if the marketplace is efficient for premium selling or inefficient and much more apt to premium buying. And if you take a quick glance at this, here we're inside the expected move, inside, inside, inside. Even though we cracked over here, we ended up inside. Okay, here's actually a breach of the expected move. This is a breach, this is a breach, this is a breach. Okay, what we've actually found in a lot of research here is ultimately when the market starts to actually break apart, it continues to break apart. And the premium sale, even with extraordinarily high implied volatility, I think everybody would agree that in early March, we had extraordinarily high implied volatility. Did you realize, though, even with that high implied volatility, premium sellers came out of the woodwork right here? They got crushed there. They got crushed here. They got crushed to the upside. Okay, week in and week out, we were still actually breaching expected moves, which ultimately means actual movement in the market exceeded implied volatility. And the one cautionary tale I'll tell you right now is looking at this. Okay, we've had a lot of efficiency once again hitting this marketplace in the last couple of weeks. This is not like independent coin flips. You're efficient, you're efficient, you're efficient. All of a sudden we snap apart. Be real careful this summer and look for the marketplace to return to that inefficiency where you're getting actual market moves that are far exceeding implied volatility. So, and I've been tracking these now for I've over 3 years of data of week to week expected moves. You can come in here and you can look at other volatile times. Great way to actually examine though if the marketplace is being good animal or bad animal. And when it's wild, buying premium, I mean, you could do something as easy in these times. You could have bought straddles, literally bought straddles on a week-to-week basis and made money through there. It's, again, kind of an interesting premise. Been studying it a lot. That along with this implied volatility range, it's kind of a neat way to view. Right now, I'm not a premium seller, not a chance. I am a net buyer of premium. I'm buying way out of the money VIX spreads. Those are a bit of lottery tickets, but hey, they pay out once every couple of years. It's going to be worthwhile for us to have done some of those. So fire away. I know you guys have Thinkorswim questions, so go for it.
Okay, let me repeat or read some of the ones. One of the ones is, how do you find the profit and loss for calendar spreads? TOS does not show that, according to Kaufman.
Okay, are they implying like multiple rolls for calendar spreads? Like if you do multiple rolls on calendar spreads, or how do you simulate profit and loss? Just give me an idea of exactly what you're looking at in here, because calendar spreads could be a little difficult.
He says, how do you simulate, he says, profit and loss?
Okay, the best way to simulate profit and loss of a calendar spread is not necessarily to come to the Analyze tab here. The best way that I've actually found to simulate, P&L for a calendar spread. Here, I'm actually going to pull up the spiders. I'm going to open up a 4-day option. I'm actually going to knock down the number of strikes to 8 strikes. I'm going to open up like a 15-day option. Okay. The next thing I'm actually going to do on a calendar spread is I'm going to drop from volume over here, options, theoreticals, and Greeks, and pull up a theoretical pricing calculator. Okay. So here's the theoretical pricing calculator. The first thing you want to do in a theo pricing calculator, okay, it'll actually have this entire calculator. You hit reset. Okay. The theoretical pricing calculator is always going to be the mid price between the bid and ask, because this theoretical pricing calculator is actually working off this implied vol. Okay. I want to clarify something. A theoretical pricing calculator is not designed to tell you if something is overpriced or underpriced, because that doesn't exist, right? In an ARB-friendly market, that doesn't exist. The theoretical pricing calculator simply allows you to change the variables, okay, and kind of figure out your forward future risk in this. So if you take a quick glance, here would be a calendar spread. I'm just using like a 312. So if I were to turn around and sell one of these, buy one of these, you're like, okay, so what's this calendar spread going to be worth? the best way to figure out what that calendar spread is worth, okay, what you do is you start and you move the date forward. So here's a calendar spread that only has 4 days left to live. Just take the date, push it forward 1, 2, okay, 3 days. Stock price, adjust up, adjust down, okay? I wouldn't even mess with the volatility. Don't even bother, okay? Don't even bother unless you're trading, 50 or 100 contracts. Wouldn't even bother with the volatility in here. And then you get a feel. This is actually your decay of the 312, right? There's your decay of the put. Here's the decay of the longer dated put, and you got it. As the best way, though, to simulate what this spread is going to be worth. And immediately somebody will say, no, you should take it and you should go over to the Analyze tab. Actually, you shouldn't, because the Analyze tab uses a vastly different methodology, okay, for solving for theoreticals, right? So for the simplicity, okay, of the trade tab, I would never leave the trade tab, and I would just look at this spread and say, what is my 312 for June 8th worth, and what is my 312 for June 19th worth? That is the cleanest way to simulate. Now, people are going to get all kinds of crazy on me, and they're going to go, well, you could actually come in here and you could align, like this is actually turning the option chain into a calendar spread. I find this absolutely hideous. Okay, I can't stand doing that, but I much prefer to keep it to the singles. I know somebody wanted that feature in there, but it's hideous. Don't make me do it again. Anyway, the theoretical pricing calculator in here, it's one of the greatest tools. I mean, keep out of the Analyze tab for like calendar spreads. One of the main reasons is the implied vol is different for the 4-day options than the 15-day options. And if you're here on the trade tab, it accounts for the differential in volatility. But if you go over to the Analyze tab, it uses what we call a fixed or VIX style volatility. So there's some big differences. Like you can rely on the Analyze tab, right? Do not use the Analyze tab though anytime around earnings. If you use the Analyze tab around earnings, most of your analysis is going to be wrong. And you say, well, why? Okay. The Analyze tab uses a 30-day, okay, what they call VIX style, okay, IV. So if you're doing an earnings trade, your earnings trade is possibly less, okay, than 9 days. So if you're less than 9 days, did you know a 30-day VIX style, it can't even see volatility with less than 9 days. So you would basically be analyzing your trade off the wrong volatility. You're much better off to stay here on the trade tab and analyze the trades using this theoretical pricing calculator. Hope that answered that one.
Another question: can you talk about the rolling strategies feature from Richard Cromer?
The rolling strategies feature. So you're actually talking about the feature where it rolls the trades for you. I'm going to make this easy. Don't use that piece of crap. We built that one to appease a board member. Don't use that piece of crap. If this is recorded, I don't care. It's fine. Don't use that thing. It's automatically rolling strategies for you. And what the initial, I can give you the actual reasoning of this. The initial reasoning was, okay, there was a lot of conversations, with the upper brass. They were like, man, if there was just a way to rein these traders in, these option traders in, and to make them roll everything just perfectly on time, and that way it would almost be like an annuity of commissions. And the irony is, so we built this rolling strategy. We're like, that's great. We spent like $500,000 building the rolling strategy. Go, nobody's ever going to use that. You are way better off rolling stuff by hand. One thing I'm going to really advocate to you, if you're in this business, okay, you're going to be better off as a retail client. Like people get fixated on all these, like, I'm going to build my own algorithms and trading systems, and they get so deep into like development of this, and before you know it. And by the way, I'm picking on anybody in here that's an engineer, which is probably half of you, right? They build these like systematic strategies. I'm going to tell you from the brokerage standpoint, okay, nobody ever trades that stuff. It doesn't last, doesn't work. And the rolling strategy absolutely will work. Like this, it'll work. It'll automatically roll trades for you. But I'm telling you, the execution, The give up in the execution is it's just terrible. It's terrible. Like all you needed to do was spend 30 seconds to look at your trade and to execute it. So I have some fairly strong feelings on that one. I would not suggest you use the strategy roller. And you can see under my strategy roller here, I've got eligible positions for some of these roles. I'm not using them. Okay, not gonna happen. Hopefully that kind of cleans that up a little bit. I wish this was never built. I said it right out loud.
Okay, it
There's a couple
does.
features in there. Yeah, go
Uh,
ahead.
Robert Hubel, can you see the risk graph while in thinkback testing?
So okay, go to the Analyze tab. You go over to Think Back. You're like, where is my risk graph? And the answer is no. So you can't see a risk graph in like Think Back testing. So Think Back really limited in terms of like functionality. It was the first shot that at Thinkorswim that we took at back testing. And it wasn't a failure at all. It's kind of cool, but you have to understand think back is just end of day data. It's what we call snapshot data. So right at the end of the day, the server comes by and just boop, takes a picture of all the data in here. I would not rely on the results in here as if you're actually like testing your strategies. I wouldn't rely on the results in here. One of the things I use think back for every single day, I'll look at things like the implied vol, what was the change in here, but you absolutely cannot see the risk graph. Which you can do, and what I would suggest if you're like you're really into this stuff, you could actually use on demand. And in on demand, you can go back to certain days, and that's a little bit more complicated. But in on demand, you can go back in time, recreate a trade, drop it in here. But I'll give you one even better. Okay, one better is just simulate your trade and run it through the Analyze tab and forward test it. Don't back test it. Try to forward test it a little bit. But no, you cannot see the risk graph inside of those back trades, which is yeah, again, I think that the back testing technology in here on Think Back is very rudimentary. At best.
Okay, Shakri asks, how can we mimic this TOS chart study or think script? Is there a way to capture historical expected move from TOS?
Is there a way to capture historical expected move? So are you talking about like auto expected moves? So this is actually the most complicated script ever in the history of like Thinkorswim. What you're actually looking at here is historical expected moves, and I can pull it up for any given product. This is, I think, what you might be referencing. It is not a perfect script. It doesn't work well around earnings. Okay, when I say it's the most complicated script though ever written for this platform, here you can take a look. This is how I actually do a tremendous amount of research on Thinkorswim. There are what, almost 500 lines of code in here. But here's the coolest part of this particular script. There are hidden aspects to the script where you can actually come in here, show high bubble, show low bubble. Okay, I can get a feel for how many times you closed inside the expected move, show daily touches, like what's the probability of touching. Okay, it has all of that embedded inside of the script, and probably that's what you're looking for. So I had a buddy of ours here at Theo Trade script this one. This is the kind of stuff like they would frown upon at TD Ameritrade. Somebody like myself writing scripts. So instead, we had somebody else write the scripts. But I'm no longer a registered rep. So yeah, we build a lot of scripts.
Excellent. Eric G asks, too many times the market maker will fish and take me out with my stop loss. I still want a stop loss, but how can I get the market maker to play nice?
Okay.
I'm only doing vertical spreads.
Okay. The easy answer for that is this. Market makers, they don't even look at trades anymore. So, I mean, I know the people that fill the other side of your trades. I've actually, negotiated with them for the better part of almost a decade. And that's Citadel that fills a lot of your trades. And you got to understand something about these firms. they could care less. They're not trying to take you out of your trade. If you use a vertical spread and use stop orders, you're already dead. There's no possibility of profitability with stop orders on spreads. Okay. And what's going to occur, and people don't like this, but this is the bottom line. Okay. What's going to happen to you, especially in recent trade. Okay. Markets right now have had some very volatile openings. Even in like mellow days, they're volatile openings. So as a market maker, you open up your bid offer spreads right here. You open them wide. So here's a market right now on your screen of 570 at 580. Okay. But if I'm a market maker, I'm going to open that thing at what? Probably going to open it 550 at $6. Okay. So I'm going to open the marketplace wide. Why am I doing that? To protect myself. I don't want to get clipped by somebody that comes in with a big bid or bid offer right at the cash open. So throughout the course of the day, if these little patches of volatility hit because, the administration tweets, again, it'll shift to a wide market. That wide market is just clipping your stops higher or lower, and there's nothing you can do about it. What I strongly suggest, if you use vertical spreads, I've been asking this question for 20 years. A vertical spread, an iron condor, whatever it may be, is a defined risk trade. Why further define your risk on an already defined risk trade? So we say, well, I don't want to lose that much. Good. Do smaller contract size. I mean, you have to trade smaller size. You will always get taken out in those stop orders. And when I say always, I mean, all you have to do is look at your vertical spread, right? Cruise over here to probability of touching. Okay. Look at the short option in your spread, and you pretty much know that you're going to get, taken out X number of times. I think the best way to do it is look at the spiders, open up like here's some 15-day options. Okay. If you, I'll knock down the number of strikes. If you sell a spread, okay, let's say you sold these 316 calls in your spread, you have a 69% chance of it actually touching or exceeding the 316 level. If you use a stop on this spread, you're dead. You're dead. I mean, it's mathematically impossible that you're not going to get stopped out a substantial amount of times. And I think that's a great way to kind of delineate this. But don't hate the market makers, man. Hate the game, because that's what we're at right now, is a wide marketplace. And I don't know if anybody knows this, but the firm Citadel, which fills a lot of your orders, okay, anybody heard the story? Okay, the story goes like this. Oh, in early March, they saw the pandemic coming. They packed everybody up, including a lot of their families, moved from Chicago, rented a Four Seasons hotel in Palm Beach, dug trenches, laid fiber, okay, sequestered every employee, nobody gets in, nobody gets out, and they're making markets. And they're still partially in Palm Beach right now, making markets. Everybody's locked down, including their families in the resort. Even the food trucks have to sit there for multiple days before they're allowed to enter or exit. But the employees haven't seen their families in like 3 months, but they're getting paid extraordinarily well. And that's who's making your markets right now. There's just probably I've noticed a little bit more of a lag time in getting filled, but the bid offer spreads are wide right now, and they're wide, especially in the morning. Because with the VIX, I mean, how many of you have actually traded in a 26 VIX that's lasted almost 3 months? Again, the answer is really not too many of you, because it hasn't happened but a handful of times in the history of the marketplace. It's just an interesting kind of facet. Again, don't use stops on spreads right now. There's no way to protect yourself. You got to trade either smaller size or go further out of the money.
Flynn R58 asks, could you please explain what volatility smile approximation is in the volatility calculation mode of TOS calculation settings?
Sure, I actually built that. So that was one of the tools we actually built. So if you come over here to where it says options theoreticals or Greeks, you pull up implied vol. I'll change this other one to delta to not confuse it too much. So here we have delta. Here we have implied vol. So the calculations that are done on this platform, okay, are from implied vol. When I say calculations, delta is a calculation. Probability, okay, like prob of touch is a calculation. Probability of expiring is a calculation. Well, right now, the way that I like it, I like my trade tab to be set to what we call individual implied volatility. When I say individual implied volatility, it's the implied volatility that is over here is derived specifically from the middle, okay, or the mid of the bid offer in each individual strike. Then, which you have the possibility of doing, come over here to setup, go to application settings. Oh, it should be under calculations, individual implied volatility or volatility smile approximation or fixed vol. Let's start with fixed volatility per expiration date. This is actually a fixed volatility, but it's basically using is one volatility. It's using this volatility for all strikes, but that changes all the calculations. What a volatility smile approximation happens to be, come over here to calculations, volatility smile approximation. It's approximating, okay, what the volatility should be, or based on what? Well, it's kind of based on the at the money, and it's actually like an averaging model. It's a smoothing model. And that's all it really is. Because what happens sometimes in the after hours is you get an option that's out of alignment. Like this option could be 362 and this one could be $5. And you're like, oh, it's screwing up everything, man. My calculations are all off because this vol would be like 28%. So the volatility smile approximation smooths it in the after hours. And the reason that that tool exists, it's not for you, okay? The reason that the volatility smile approximation exists is because in calculating portfolio margin is calculated from implied volatility. If the implied volatility is screwed up because of a big bid or big offer on the close, or the markets just get wide, it screws up all the portfolio margin accounts. So the portfolio margin actually runs off of smile approximations. Anyway, we put that feature in there for the hell of it. But I prefer the individual implied volatility. So I guarantee an engineer asked that question.
Oh, I see. Another one that's on the same general theme, when you display a quick chart of a specific option, you see a blue line that is theoretical option price. How is that calculated? Is that line based on the IV for the option?
Yes, it's just based on the implied volatility for the option. And so if you want to chart an option, I don't know why people want to chart options, okay? But if you really wanted to chart an option, you could actually drop the option, okay, over to the chart. And yes, this is, that's exactly what it is. It's just, you can actually come in here and you can look at the, they don't let you see the code anymore of it, but it's just based on the implied, or theoretical, I should say, the theoretical IV in there. See, the thing is with options, when you start to chart options, why I don't like it, options don't necessarily trade continuously. When you're trading a stock, like you're trading something like the spiders, okay? The spiders trade 6.5 hours a day. They're like boom, 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 boom. They're even trading here in the after hours. They trade constantly. But, this 312 call may only do, a trade. It may be 2 minutes before it sees another trade. So that little blue line is basically meant to like kind of fill in the gaps, of that option not trading for a period of time. There's strikes in here. I mean, one of the biggest problems for the brokers right now is too many strikes. Too many strikes, too many options. It's just so much data to deal with. Fire away.
Oh, yeah, go ahead.
Oh, no, it's all you.
Vadim says, can I find all stocks with options with expiration from 6 to 15 days that put with 20 cents, negative 20 cents or less costs $4 or more? I'm just reading this literally. I don't know.
So you want to you're looking for something really, really specific inside of an option. I mean, one of the first things when you said from from 4 to 16 days, one of the first things you do, you go to the scanner, go over here to option hacker, don't scan an all optionable. You probably want to scan an all weeklies. Okay. And from there, so I'm scanning just weeklies, and there's only X number of weeklies in here. I don't know why it's actually showing. Oh, because that's the total number of options. And then you can start adding option filters. Okay. You can add different option filters in here. You want to scan by implied vol, net change, open interest, actual price, the option, the bid, the ask. Yeah, you can scan for pretty much anything in here. I mean, I'm not sure exactly what they're scanning for, but
I'm sorry, he added on at 20 delta.
Okay, so you also want to scan for a specific delta, sure. Okay, so again, you come in here, you can add another filter, Again, for an option filter, if you want to scan specifically for delta, minimum delta, maximum delta, not a problem at all. You can go, but you do have to denote, and you got to be careful in here, okay? Negative deltas gets it kind of confusing for people. So make sure that you're scanning properly. So I'm just, again, delta is one of the parameters in there. You could do delta, add another filter, another option filter, put delta plus price in here. You name it. It's in there. I will say the scanning functionality on Thinkorswim, it's second to none. There's nothing even close to the scanning functionality of what these guys have built in here. I mean, this thing is looking through right now. This is just in weeklies. It's actually scanning through 632,000 different options. And it takes about 2 seconds right now to return results. Apparently not in the after hours. It might not always work perfectly in the after hours because it's got some extraneous bids and offers in there.
Okay, John asks, if there are too many strikes for the brokers to deal with, do you see that trend slowing down or speeding up? Would you expect daily options in the future, hourly options?
They're trying to knock down the number of strikes right now. There's actually some legislation flying around to knock down. I mean, we're close to dailies already. Look at the spiders. There's Monday, Wednesday, and Friday. I would assume that they will eventually add a Tuesday and a Thursday expiration, but they'll just do it for a handful of products. It'll be the spiders. It'll be the SPX. The SPX is always kind of the experiment in there. They always add that first. So it's Chicago, right? If they can charge you more, they will. So I personally have some feelings though about the weeklies. The weeklies, I think, changed the entire nature of the whole marketplace because when you have an option for one day, for 4 days, the efficiency of the marketplace is that much greater. People point the finger to the Fed. It's not the Fed. It's actually the fact that they added Monday, Wednesday, and Friday. And all of these firms are gamma scalping against Monday, Wednesday, and Friday expirations now. It's locking markets in tighter and tighter ranges, which the interesting irony of that is it makes the market more efficient, okay? But when the market becomes inefficient, it rips it apart because the same negative gamma that they're hedging against, can become the enemy very, very quickly and cause wild, 3 and 4 and 5 sigma moves inside of the marketplace, which is some of what we've seen in the last couple of weeks.
Okay, Robin Hubel asks, what is your favorite strategy?
So, when I talk about like favorite strategy, I would have to say that, favorite strategy and strategy that's kind of made, the most capital in the last, 3-4 years. A strategy that I've kind of developed called a risk twist spread has been by far the most profitable. You can't do it though right now. The volatility is too high. The risk twist just goes out there every quarter and it literally just buys like kind of a funky ratio, out of the money put ratio spread. And if the marketplace falls apart, you make a ton of money. And if the marketplace doesn't fall apart, you don't. And I can show you, if I go over to a product called like the XLU, I'll cruise to my monitor tab, show you my account statement here. I probably got to go back like let's go back 120 days. Okay, I could just think of a couple like off the top of my head. Not a whole lot of trades that I've done in this particular product, but if you want to see what a risk twist looks like, this is it. It's here's one that I paid for like 96-cent debit, right? And don't worry about these diagonals. These are completely different trades. But here's one where I actually opened in early February. I had Corona this, Corona that. I had no idea. And here's one where I actually closed for 512. Another one for 1272. I had some size on. That's in the XLU, but I hit this the same strategy in umpteen different products in and around that same time frame. But we've also done really, really well. Lately, we've done phenomenally well with ratio back spreads. Just the simplicity, call ratio back spreads specifically. If you take a look at some of my trades here in IWM, these are actually really recent too. These are all like April trades. Putting them on for a small credit, taking them off for a huge credit. Back spreads have been where it is at right now. You name a product, and I've probably a major ETF product, and I've probably pulled off a couple of back spreads on it. And the reason that back spreads are working so well, if I apply this expected move to it, when I was talking about this expected move, look, shattered expected move here, shattered expected move here, shattered expected move here, broke to the downside, shattered it here. I mean, every one of these breaches of expected move to the upside is a great degree of profitability. And the funny thing is, with these back spreads, most of the time when you're wrong, it doesn't matter. You still get to keep like a 43-cent, credit. The valley of death we deal with by exiting the strategy well before expiration. But back spreading, okay, back spreading and a version of this risk twist spread have been kind of the go-to thing for 2020. I would say that the back spread has probably been the largest degree of profitability. And I think I just hit one here. This is the XLF. I trade a lot of XLF, but in the XLF, we also we hit a couple of back spreads in here. These are all trades that have been exited, literally this week. Okay, some of them are only 20-cent plus credits, but I mean, we're talking dollar-wide back spreads in a in a $22 product, which this ain't half bad. Some decent credits. Almost every trade in here, though, is a credit. And again, I've been trading some size inside of the XLF, because if you've missed it, the XLF has actually shattered its expected move the last 2 weeks in a huge way, and that's made us really good in terms of strategies. That's why I said, I'm buying premium right now, not selling it, because I think it's far more advantageous in the near term. That's kind of how I'm dealing with this entire up move.
TOS shows, according to Bob Rifkin, TOS shows the IV for each individual, for each option, but I've not found any way or website to look at a chart of a specific option's IV over time. If you were selling the option short, you would like to see the recent prior IV, so a chart would be helpful. If you were buying an option, you would like to buy a low IV versus history.
So if you want to track implied volatility, there are a couple of ways to track implied volatility. First of all, it's a little bit futile, and I'm actually going to show you why. So if you're tracking implied volatility on an individual option, IV, okay, is all dependent upon skew. So if you look at an implied volatility skew, it looks like this. This is like a volatility smile. Well, you sold the option here, and if the market starts moving against you, you're actually slipping down the skew, okay? It has nothing to do with changes in implied volatility of the marketplace. If the marketplace rallies, implied volatility goes down, but implied volatility goes down, but you're also slipping down the skew. Anyway, neither here nor there. If you wanted to track implied volatility and you wanted to see what it was, I'll tell you the best place to do it, come over here to Think Back. And, you're like, but it doesn't chart it for me. Yeah, but you can still look at implied volatility every single day on each unique option. Okay, so you can absolutely kind of visualize implied volatility in here. Now, you could take the, could you chart an option? Yeah, you can come in here and you can start to chart an option, and you can get intraday implied volatility on an option that is charted. But I would feel that the best place to do it would be Think Back. Okay, but I'm not that hot. I'm honestly, I'm not that hot on looking at individual implied volatility, because there's no methodology to it whatsoever, because just because the implied volatility moves, it didn't mean anything because you slipped down the skew or up the skew for that matter. I mean, if you've ever looked at VIX options, okay, VIX options accentuate the problem. I trade quite a bit in the VIX. So if I take a look at VIX options and I open up all the options, you can see some of my positions out here. That's right, people. I am massively long the 75-100 spread in the VIX. 75 days out. I'm also 103 days out. Okay. So that is right. But if you take a look, like if I bought or sold this option, it's 132% option, right? But if the marketplace if the volatility starts rallying to me, look what happens. See, what I'm actually doing is I circled it. I'm shifting down the skew. So you can look all day long at implied volatility. It can even make a bit of difference. As the market's coming up, the implied volatility is actually going lower. I was just showing you, like, this is what I mean by, like, when I circle it and I'm showing you the shifting skew. So it doesn't do you that much good to track it that way.
Chuck asks, can you have multiple scan search results on the screen at the same time?
Absolutely. So there's actually a really cool feature that not too many people know about in here. Okay, so you just built a scan, right? You built a scan and you're really happy with your scan, and you go to your mobile device, you go wherever. So I'll show you actually a couple of my scans in here. If I go to Stock Hacker and I come in here, load scan query, I've got a ton of scans, and I like this one, Theotrade Contrarian Scan. So it doesn't matter what the criteria is, but it's contrarian scan. Hit scan, boom, there's like, the results, yada, yada, yada. Yeah, I think you guys kind of get that part. And here, there's all the criteria for it if it doesn't have earnings. So there's my scan results. Now, remember, the scan that I just ran was called the Theotrade Contrarian Scan. Now, go over to the trade tab, nothing to see over here. Open up this left side bar. See this watch list right here? Under the watch list, go into your personal, okay? Come down to Theotrade Contrarian Scan. What it's doing is it's actually running the same scan. And correct me if I'm wrong, but I think it's about every 3 minutes, it will update the results of this particular scan. And then you're like, can I run more scans? Yeah, all you have to do is just detach and open up more watch lists. You could have an entire separate screen just running scans in the background. And it's constantly surface scanning. And I think it's every 3 minutes. And you can even have it, you can come in here and alert when the results change. So when the results change, be like, let me know. Apparently I can't type right now, but let me know. And it creates it so every time the results change, it'll go ding, and it'll let you know that the results changed in that one. So not only am I watching multiple scans, I'm having alerts, because when something changes in here, whether it's added or subtracted, I want to know about it. And of course, you could save it as a watch list in there. It's a pretty cool feature. That one was that's been around in there for a while. Very few people, I think, actually know that one exists in there.
There are a couple more questions, but before we, whether we have time for them, I don't know. But let me fit in for sure a question to you, which is to ask you to explain your philosophy in creating Theotrade and what kind of programs it has and any offerings it has.
Sure. And I don't have anything, pre-prepared for you guys, but here. So obviously I was in the trading world starting in like the late 90s. I started trading in Chicago in 98. Short time after, I met Tom Sosnoff, kind of met him on the trading floor, and we kind of hit it off. And literally I was 22 years old, and there was just one day the guys approached me and said, hey, why don't you come work for us here? We're going to build a brokerage firm. This thing is going to be called Thinkorswim. He goes, I don't even know what the hell that means, but come work for us. And so I actually built out the education division of Thinkorswim, and went on to help take the company public in 2007. Obviously, then TD Ameritrade comes in. When Tom actually left TD Ameritrade to start Tasty, he said, hey, you interested in coming? And I said, no, I have kids. I was actually having kids. I'm 20 years younger than Tom. So I was like, I'll just stay here and chill and be happy for the next couple of years. But wasn't happy. It was torture, not because of TD Ameritrade, the regulation. So I went on to actually run education for a very large part of TD Ameritrade. And I spent literally 2/3 of my day talking to FINRA, nothing negative, just talking to FINRA, the Securities Exchange Commission, and I'd had it. I had planned my exit. My exit strategy was simply this: have the last baby in October of 2014. And 3 weeks after he was born, I actually announced that I was going to exit, and I did. And in February of 2015, I left. And we knew at that point, I'd already talked to the guys at TD Ameritrade. I'm like, listen, I'm going to go out. I'm going to build an education firm because I can't do nothing. So I actually tried to do nothing for a whopping 3 months. It lasted. I actually went to work for another guy for a couple of months. I'm like, oh, this is horrible. And one of the guys that originally invested in Thinkorswim said, I'll put up all the capital. You have a riskless trade, riskless trade. And hey, come in and build this company, and we'll go for it. So we did, and it it's taken off. I mean, what Theotrade happens to be is Listen, I know you guys have been to every educational, strategy, every, class out there. There isn't anything like what we're doing on this like grand of a scale. When I say a grand scale, this is what TheoTrade, by the way, looks like. Um, we're off hours right now, right? Just to give you an idea, there's nothing going on right now. We still have 258 people talking to one another in our chat room. This is the back end chat room, okay? But there's still 258 people in this room and 58 people in another room. We have now over 5,000 members in TheoTrade, and what we decided to do was build something very similar to like kind of the model of Netflix, if you will. We provide every aspect of education, from option strategies and option newbies and technicals and day trading classes and futures classes. It's not just me. We have, if you guys have ever heard of Slim Miller, Slim actually worked for Tom for a period of time. We have Professor Jeff Bierman. Jeff Bierman is also a professor of finance at Loyola. We have Brandon Chapman. Brandon Chapman actually helped me run part of TD's education. Matt Williamson. Matt Williamson was actually kind of in this group. I mean, he was doing a lot of stuff like this. He was just trading by himself for about 12 years, ran a hedge fund, picked up Matt Williamson. We have Corey Rosenblum, Tony Rago, and we've put together an archive just to give you an idea of like the option strategy classes in here. Okay. Everyone that comes to TheoTrade has access to everything we ever did. So from day one, you have access to over 91 classes. This is just the option classes. It just goes on. And we broadcast live, 6.5 hours every single day. All right. And again, apparently Tony is in here the last couple of moments. This is an instructor. Tony's in here trading. He trades NASDAQ futures throughout the course of the day. I'm the option strategist. Jeff Bierman is obviously the technical analyst. By the way, Jeff Bierman also helped build the Thinkorswim charts. So pretty stacked crew that we have obviously in here. And we just charge $99 a month for it. That's it. And it's, there's no membership actually. You can pay month to month. Most people actually going quarterly. And it's that easy. And it's kind of it's kind of nice. We don't have to worry about the regulations anymore. I'm so thankful right now because obviously TD is being purchased by Schwab. And that's something obviously we don't have to worry about. Things are going to change over there, and we're keeping a close eye on it.
So the typical person can subscribe for $99 and access all past courses, or
everything we ever do, everything we're going to do. That's it. Yeah, I just I'll tell you, like I was showing you guys a couple of cool of the scripts that we have for Thinkorswim. So from day one, when you come in here, you're like, oh man, I really want those scripts. We give you everything. I mean, when I say we give you everything, here it is, shared right in here, shared charts, scans, and studies. We couldn't make it any easier. I actually just built a spreadsheet. It's just, as cheesy as it is. Every single script that we've ever written here, okay, is packed in here. All the shares for Thinkorswim. Every script you can imagine is in here. So from day one, we give everybody every script. From day one, we give them access to the chat room. From day one, you get different portfolios, duration portfolio, infinity portfolio, and you get archives to everything, and everything's searchable, you name it. And I'll tell you what, no matter what genre of trade you have or are looking for, we have something. And again, the instructors here, they're second to none. We really spend a lot of time, less on marketing, more on the instructors that are actually that built TheoTrade.
And Jeff Roth has posted to find out more. I think he's with your firm. He has posted find out more here, theotrade.com/join.
Yep, excellent.
Anything else you wanted to add?
No, if you do pop in there, by the way, never hesitate to shoot us an email. Whether it's myself, Jeff Roth is also the co-founder here of TheoTrade, but never hesitate to come in emails. It's just support@theotrade.com. We use a common inbox. If you guys ever need to get a hold of me after today, by the way, also under some of the resources here under TheoTrade tutorials, we have specified tutorials. If you're really into Thinkorswim, it's part of it. The Analyze tab, Okay, it's kind of my baby, but here are, again, a number of videos specific to the Analyze tab. You guys will not be disappointed in some of the tutorials that are also available inside of here specific to Thinkorswim. And clearly, we use it on a day-to-day basis.
I know Matt Williamson, at least he's active in many groups that I'm in. So
Yep.
I know he, and I recognize a number of the other names there too. So there's a huge variety of differing opinion within TheoTrade, and we hear echoes of it throughout the trading community. So I know that it's a significant resource. Thank you very much.
Thank you for having me.
Very good. Please get in touch with Don or Jeff after first taking a look at theotrade.com/join if you're interested. I hope some people do join, and hopefully that way we'll be able to call Don again sometime in the future.
Thanks for having me, guys.
Thank you.